Today, we're going to learn about the major players in the financial markets by diving into the two main players, the buy side and the sell side. Let's get started. In the financial markets, market participants are broadly categorized into two groups, buy side and sell side. So what's the difference between these two? The buy side refers to entities that purchase securities and other assets for investment purposes. Their primary goal is to generate returns for their clients, whether they are individuals, institutions, or governments. On the flip side, the sell side consists of firms that facilitate the buying and selling of securities, providing essential services to the buy side. Think of it as a marketplace, with the buy side as the shoppers and the sell side as the vendors and service providers. Now let's zoom in on the buy side and meet the key players. First up, we have asset managers. These firms manage funds on behalf of their clients, aiming to achieve specific investment objectives. Asset managers include mutual funds, pension funds, and exchange-traded funds, or ETFs. Mutual funds pool money from many investors to purchase a diversified portfolio of stocks, bonds, or other securities. The goal is to give individual investors access to professionally managed portfolios and spread out their risk. The typical clients for asset managers are individual investors and institutions looking for diversified, professionally managed investments. Next, we have hedge funds. These are the adrenaline junkies of the financial world. Hedge funds use a range of strategies to maximize returns, often taking on higher risks. They might employ leverage, derivatives, and short selling to achieve their investment goals. The typical clients for hedge funds are wealthy individuals and institutional investors seeking high returns and willing to accept higher risk for potentially higher rewards. Private equity firms are another key buy-side player. These firms invest directly in private companies or take public companies private, often restructuring and improving them before selling at a profit. The typical clients for private equity firms are institutional investors like pension funds, endowments, and high-net-worth individuals looking for long-term, high-growth investments. Insurance companies also play a crucial role on the buy side. They invest premiums collected from policyholders to ensure they can meet future claims and obligations. The typical clients for insurance companies are policyholders who trust these companies to manage their premiums and provide financial protection. Sovereign wealth funds are state-owned investment funds. They invest in a wide range of assets, including stocks, bonds, real estate, and private equity, aiming to achieve long-term growth for their country. The typical clients for sovereign wealth funds are entire nations looking to manage their reserves and achieve sustainable economic growth. Last but not least, we have family offices. These are private wealth management advisory firms that serve ultra-high net worth individuals or families. The typical clients for family offices are wealthy families seeking personalized investment management and financial planning services. Now let's switch gears and talk about the sell side. These are the firms that keep the wheels of the financial markets turning. Investment banks are the powerhouses of the sell side. They provide a range of services, including underwriting new securities, facilitating mergers and acquisitions, and offering advisory services. Their role is to act as intermediaries between issuers of securities and the investing public, helping companies raise capital and navigate complex financial transactions. Broker-dealers are the intermediaries that buy and sell securities on behalf of their clients. They also trade securities for their own accounts. Their role is to facilitate trading and provide liquidity in the markets, ensuring that buy-side firms can execute their investment strategies efficiently. Market makers are firms that provide liquidity to the markets by standing ready to buy and sell securities at any time. They play a crucial role in ensuring smooth market operations. Their role is to, quote, buy and sell prices for securities, helping to reduce price volatility and enhance market stability. So, what services do sell-side firms offer to the buy side? They provide research and analysis, trade execution, market making, underwriting, and advisory services. Essentially, they equip buy-side firms with the information, tools, and support they need to make informed investment decisions and execute their strategies effectively. Understanding the distinction between buy-side and sell-side entities helps us appreciate the symbiotic relationship that keeps the financial markets vibrant and efficient. The buy side invests capital to generate returns, while the sell side provides the necessary services and liquidity to facilitate those investments.